There's a 401k loophole hiding inside your benefits package, one that lets high earners stash up to $47,500 extra dollars per year into a Roth, completely tax-free for life. Almost nobody uses it. It's called the Mega Backdoor Roth. The IRS sets a total annual limit on what can go into your 401k from any source. In 2026, that ceiling is $72,000. Most people think the 401k cap is $24,500. But that's just your portion. The $72,000 is the combined limit. Your contributions, your employer's match, and after-tax contributions. Here's how the structure plays out. You contribute your standard $24,500 in pre-tax or Roth deferrals. Your employer adds a match, call it $10,000. That leaves a $37,500 gap before hitting the $72,000 ceiling. Many 401k plans let you fill that gap with after-tax contributions. This is a third bucket, not pre-tax, not Roth, but after-tax. It grows tax deferred. Three things have to be true for this strategy to work for you. First, your 401k plan must explicitly allow after-tax contributions. This is not the same as Roth contributions. Roth is post-tax. After-tax is its own separate bucket. Read your plan document or call HR. Second, your plan must offer either in-plan Roth conversions or in-service distributions. Without one of these, your after-tax money stays trapped, growing tax-deferred but taxed on withdrawal. Third, you need the income to actually fill the after-tax bucket. If you can't max your standard $24,500 deferral first, this isn't your strategy yet. Most large tech, finance, and biotech employers offer mega backdoor plans. Most small business 401ks do not. Federal employees in the Thrift Savings Plan do not have this option. The income required to fill the bucket is around $180,000 or higher with disciplined savings. Let's run real numbers. Single filer, $200,000 in income, 24% marginal bracket. Your 401k allows mega backdoor contributions. You max your standard $24,500. Your employer matches $10,000. That brings you to the $72,000 ceiling. After-tax headroom, $37,500 each year. Assume a 7% annual return, the long-run inflation-adjusted average for the S&P 500. Over 20 years, the future value of those after-tax contributions, converted to Roth, is $1,537,000. All of it tax-free in retirement. Now the alternative. Same $37,500 per year, but going into a regular taxable brokerage account instead. A taxable brokerage faces two tax drags. First, dividends and short-term gains get taxed every year, about 1% of annual return lost to tax drag. That reduces your effective return from 7% to 6%. Second, when you sell in retirement, long-term capital gains tax of 15% applies to all the appreciation. After 20 years at 6% effective return, the same $37,500 annual contribution grows to $1,379,000. Then you owe long-term capital gains on the appreciation, about $94,500 in tax. Net amount in your pocket, $1,284,000. The mega backdoor Roth advantage is roughly $253,000. Same contributions, same returns, same investments. The only difference is which account holds the money. Pure account-level tax arbitrage. And this understates the real advantage. The Roth has no required minimum distributions. It avoids Medicare IRMA surcharges in retirement. It passes to heirs tax. Here's exactly how to set this up. Step 1. Find your summary plan description, the document your 401k administrator publishes. Search it for the phrase after-tax contributions. If the plan allows them, you'll see explicit language. If not, This strategy isn't available, and your work stops here. Step 2. Check whether your plan offers in-plan Roth conversion. Most modern plans at large employers do. It's called automatic in-plan Roth rollover or pre-conversion election. This is what makes the strategy practical. Without it, you'd need in-service distributions, which is more paperwork. Step 3. In your benefits portal, max your standard contribution first, $24,500 for 2026. Do not skip this. Your employer match usually only applies to standard contributions. Step 4. Increase your after-tax contribution election. Set it as a percent of salary calculated to hit your target. On $200,000 a year, contributing $37,500 after tax is about 19% of pay above your standard deferral. Step 5. Turn on automatic in-plan Roth conversion. Every plan with this feature has a setting, sometimes called Roth in-plan conversion or after-tax to Roth conversion. Enable it. Step 6. At tax time, you'll receive a Form 1099-R for the conversion. 6 things to watch out for. First, the pro rata rule that breaks the regular backdoor Roth does not apply to mega backdoor conversions inside a 401k. That's a common confusion. Pro rata only applies to IRA conversions. You're safe inside the plan. Second, if your plan does not allow in-plan conversions or in-service distributions, after-tax contributions get worse over time, not better. Growth in that bucket is taxed on withdrawal. Without conversion, you're creating a future tax bill. Skip the strategy entirely. Third, watch out for highly compensated employee testing. If your plan fails its annual ACP test, a portion of your after-tax contributions can be returned to you the following March, creating tax complications. Larger plans rarely fail. Smaller plans sometimes do. Fourth, track your cost basis. After-tax contributions create basis that should be separated from pre-tax assets at conversion. The plan administrator usually handles this, but verify. Fifth, if you leave the job, you can roll the Roth portion directly to a Roth IRA tax-free. The after-tax portion rolls out cleanly too. But ordering matters. Work with a tax professional on the paperwork. Sixth, watch the $72,000 ceiling. Exceeding the 415C limit triggers IRS corrections. The Mega Backdoor Roth is the single largest tax-free retirement opportunity available to W-2 employees in 2026. If your employer offers it and you're not using it, you're leaving $250,000 on the table over your career. Next week, we cover the regular Backdoor Roth for everyone whose plan doesn't allow this strategy. Subscribe if that's